Welcome to this explainer. We're watching something truly fascinating unfold right now. Bank of America, a massive, traditional, rate-sensitive legacy bank, is trying to pull off a massive pivot. They are actively positioning themselves to become a digital-first, AI-enabling powerhouse. Now, to really grasp the stakes here, we first have to respect what this legacy institution has already pulled off. Over the past 3 years, they've delivered a staggering 140% return to shareholders. I mean, that is a phenomenal track record for a traditional bank. But you know how the market is, right? It's ruthlessly forward-looking. What got them here won't necessarily keep them there. So we're going to dive deep into the bull case, the bear case, and the underlying technicals to figure out if this aggressive new growth strategy actually justifies the premium valuation they're trading at today. Section 1. The $250 billion shift. So back on August 12th, Bank of America dropped a massive headline that completely shifted the narrative around the stock. They announced the Critical Infrastructure Finance Initiative. And guys, this is a colossal commitment. They are planning to deploy $250 billion into U.S. infrastructure. And they didn't leave it open-ended. They put a firm, ambitious deadline on it, July 4th, 2027. And where exactly is all that capital going? That's the fascinating part. We're talking data centers, power grids, natural gas pipelines, and semiconductors. By targeting these specific sectors, the bank is placing itself right at the very center of the AI-driven industrial build-out. They aren't just financing the software, they are literally funding the essential physical backbone of tomorrow's technology. To understand how they're pulling this off, listen to Karen Fang, their global head of infrastructure. She explicitly stated that this initiative isn't about spinning up some bloated new division. Instead, it's an unprecedented, coordinated effort to mobilize capital at scale across the entire bank to meet the country's critical infrastructure needs. But here's the real friction point you need to grasp. The timeline. We are looking primarily at 5 to 7 year construction loans. That means this is a long-term compounding story, not some short-term catalyst that's going to magically pop next quarter's revenue. You're buying into a multi-year vision here. Section 2, Valuation and Digital Reality. So how exactly is the market pricing in this huge infrastructure and digital transformation? Well, if you use the excess returns model, and let's assume a 12.7% return on equity, the stock is actually trading at a 28.1% discount to an intrinsic value of about $90. That said, Wall Street analysts are playing it a bit safer, keeping their average price target around $68.77. Looking at simple earnings, Bank of America trades at a 14.1x PE premium compared to the industry average of 12.1x. Now, why pay the premium? Firms like Barclays and UBS are more than happy to justify it, maintaining buy ratings targeting the low 70s based purely on the bank's dominant position. And a huge part of justifying that premium comes down to their digital game. They are an undisputed leader here, with tools like Erica and Zelle massively boosting user engagement. But here is the catch. Their efficiency ratio remains stubbornly stuck around 61%. Why? Because those brilliant digital savings are being heavily dragged down by traditional legacy branch costs and absolutely vital investments in cybersecurity and compliance. Section 3, 3 bearish risks. All right, it's not all sunshine and rainbows, and any objective analysis has to look at the downside. There are 3 distinct pillars of risk threatening this ambitious strategy: regulatory penalties, the mismatch between project timelines and market patience, and underlying macroeconomic sensitivities. Let's break these down. First up is the regulatory overhang. Right now, there are pending OCC penalties hanging over the bank regarding their anti-money laundering controls. The market despises uncertainty, and this is actively pricing in risk, acting as a firm, concrete ceiling on the stock's multiple. Risk number 2 is a classic timeline disconnect. Like we talked about, this infrastructure build-out takes years, but Wall Street is notoriously impatient. Plus, competitors like Morgan Stanley and JP Morgan are crowding the trade with their own massive infrastructure pledges. If Bank of America fails to show immediate earnings growth while competitors crowd the space, the stock is going to face intense short-term pressure. And finally, the macroeconomic reality. Even though management is confidently guiding for 6 to 8% growth, Bank of America remains one of the most interest rate sensitive banks out there. So, if the Federal Reserve goes ahead with deeper or faster rate cuts, it's going to create immediate net interest income headwinds. Section 4, the final verdict. So, what's the bottom line here when we weigh this massive $250 billion pivot against the stark realities of legacy banking? Honestly, it's still a story of incredible quality and sheer scale. Just look at the recent fundamentals. Revenue climbed over 15% to $31.6 billion, and net income jumped nearly 27%. The core engine is absolutely firing. Ultimately, we're looking at a bit of a split narrative. If you're a long-term investor willing to look past the near-term volatility, their dominant deposit franchise offers a highly compelling margin of safety. But for the cautious investor, heeding the cooling institutional sentiment and current hold ratings to wait for a better entry point might just be the wiser play. And this right here brilliantly illustrates the central tension of the stock today. It leaves us with the ultimate question. Is this infrastructure master plan going to define the bank's next dominant decade? And perhaps more importantly, are you willing to wait for it?